Good afternoon, everybody. This is Brian Dewhurst with Uncommon Wealth Partners coming at you with a mid-November market update. And as the title alluded, should we be thankful? Wanted to go over a few things here. We're going to cover year-to-date performance of the U.S.-based indexes that we're kind of all familiar with. We're going to go in depth on one of our indicators, give you a highlight of all of our indicators, and then give you an update of what we're looking at long-term. So let's dive into it here. Obviously, you can read the year-to-date returns for the top three U.S. indexes. That's 1/1/2017 to today. The first day of market trading actually this year was January 3rd. But the S&P 500 as of today up 11.96. The NASDAQ as of today up 23.5. And the Dow Jones as of the close today up 17.04%. So very strong showing, double-digit returns so far year to date on all three U.S. indexes as well. So looking good there, and kind of as the video alluded to, definitely should be thankful for double-digit returns in the stock market. So let's jump into our indicators. I wanted to go in depth today on this one. This is one of the indicators that we've been using the longest, and there's a lot going on in the screen, so I wanted to break this down. I know in the last video we kind of flew through it, so I wanted to give you more context on this. We're going to go a little deeper today so that when we show it in the future, we don't have to spend as much time on it. So in this indicator, there's several things going on, but primarily you'll see here the first set is the blue and then the red candles. So we have it set to only show us two colors. And what we're trying to see is long-term trends. And so you can see here we have this set on a 20-year monthly here on the S&P 500. And then you can kind of see on this chart, there's a green kind of top band and a lighter purple lower band, and then this white line. And so the green band is kind of the top, just average price. And then the bottom is an average on the lower end. And then the white is the 21-day moving average. And if you kind of think, I use the analogy of kind of like bumper bowling. When the price hits the top bumper, let's just call it bumper, it's easier. When the price hits the top bumper, it then activates these red arrows. So all the red arrow means is that the price is going to revert to the white line, which is kind of what we have set as the mean. And then vice versa, when the price you see here, this is the financial decline. When you see the price hitting the bottom bumper, it then can activate the green arrow, and the green arrow suggesting that the price will revert to the white line or the mean. And obviously that's more of a bullish indicator because it's coming off the bottom bumper. The arrows aren't necessarily buys and sells all the time. Now, it just so happens that when you look at this chart, which is again the S&P 500 over 20 years, we only have three green arrows. This is at the bottom of the tech wreck. This is at the bottom after the financial crisis in 2008, 2009. And then this is the newest green arrow here after Brexit leading up to the election. So three green arrows over the last 20 years. So you can see they don't fire very much on the buy side. Obviously, we have more red arrows on the top as price hits that top bumper more often as we're in these trends. So that's kind of the top part of this chart. And each dotted line we have set here to a year. So you can see these are long-term trends. This was about April of 2009 until here, mid 2015, so 6 years. And you can see here the bottom here in 2002 up to the peak here in 2007. And I drew these lines on here so you could kind of just see all the indicators, how they line up, and we'll get into that. But so let's just jump into that one next. So these indicators basically pull from different time periods of charts, shorter term time periods of charts, and they're just kind of like traffic lights, so red light, green light. And so this is a perfect example. So the 0-1 is the shortest time frame, and then 1, they get out further. And so you see how the red turns faster on the shorter term charts, because obviously, when you're looking at maybe a 30-minute chart or a daily chart or like an hourly chart, obviously those are going to turn negative far before like a monthly chart will. But we're investing for the long term, which we show is over 5 years. You shouldn't invest if you're going to be in something less than 5 years. So you see how these red dots start turning, obviously red from green. and those correspond to the red candles. And so that's kind of how we use these together and how they line up. Now, the bottom chart is what we call the squeeze indicator. And basically, this is kind of like a meter on a valve, and it tells us when pressure is building up, how much that pressure is. And so when you see here, when these dots turn red, it means that there's pressure building in the market, and the market is going to move drastically in one direction. Once it declares, down here or red in this chart, once it declares a direction, it's going to stay in that trend for a long time because we're in the monthly zoomed out chart here. So we're looking at this like very zoomed out, kind of like the forest, trying to view the forest from way above the trees, if you will. And so once this declares, it's going to be in a multi-year trend. And so you can kind of see here before the financial crisis, only one real squeeze, even though that was a violent decline down. You can kind of see by how much deeper the red went compared to the tech decline. But then you see here, this is what I wanted to kind of highlight. See how powerful this squeeze was. It's bigger than any other squeeze we've had in the last 20 years. And then we got this on this green arrow, and we've got all of our green dots on shorter term charts. So we could see with a high degree of probability, based on how this has looked in the past, that this was going to be a very big move up, and why we've suggested to stay bullish in this trend amidst all these headlines that are taking place and have always taken place, let's be honest. So that's kind of how we use this set of indicators to work together. And I kind of wanted to just show you the, these bars so you could kind of see how they work together. So now we're going to jump into another indicator. This is just simply the S&P 500 zoomed out on a monthly again. This is a 50-day moving average. So on the previous chart, we had a 21-day moving average. This is a 50-day moving average. This is kind of a classic Wall Street type indicator, very simple. You just have price up here and the 50-day moving average. So we're well above that. And so that looks healthy. Even you can kind of see there's lots of green and red intermixed. The red candle here at where we're flashing right now isn't that big of a concern overall, but something we're definitely watching. Now, the next indicator is one we're going to continue to use. This is 10 moving averages. You can see the 5 green lines and the 5 red lines, and this intentional gap that we put into this by leaving out a series of lines. So if we just continued to input and order more moving averages, this gap would be filled in, but we leave it out intentionally to try to show a change in direction and a change of trend. And so kind of, I think I alluded to in the last video, this is, we want to be in this gap. And so we have price on top here, S&P 500 on top of the short-term moving averages, nice healthy gap between them, and then the longer-term moving averages. So this one looks healthy. It does not look anything like it did during the financial collapse where the green was cutting through the red, and you see price cut through the shorter term moving averages and then cut into the longer term moving averages as they kind of then pull through. So we don't have anything looking like that as of right now. Looking good there. Next one, and this is our last indicator for the day. It's kind of similar to the first one we went in depth on, but it adds one more color. I have them colored green, yellow, and red, as opposed to just blue and red on the other one. But this one is kind of also like traffic lights. And you can kind of see here, we're green, which is good. Yellow can also be good. And when we look at this long term, you wanted to essentially buy the yellow just as much as the green. So the yellow is obviously, bullish too, but we obviously want to avoid the red candles here. And I have the 21-day moving average woven into this one as well, like that first chart. But you can kind of see here that we're on a 6-month movement here with green bars and coming out of the yellow. So definitely bullish. And then we do have this aligned with our squeeze indicator again. So you can kind of see how these work together with the squeeze, and then it fired up, which suggested a longer term trend. And then we had this switch from red to yellow and now yellow to green. So when you look backwards here, we came out of the financial crisis from red to yellow and then yellow to green. multi-year trend there as well. So all of these are looking good. Again, like I said in the beginning, we do feel like we could get some short-term weakness. We've seen a little bit of a pullback this week. The Republicans are trying to figure out the tax thing. We'll see if they get that done. Long-term, again, I think there's long-term trends in play. These companies are making billions and billions of dollars. Apple, Google, Facebook, Amazon. Wages are going up, and we have low unemployment. So a lot of the things structurally are still in place for the economy. Interest rates are still very historically low for housing, which is one of the larger industries in the United States economy. So a lot of things are happening, and we think we should be open to the probability of higher prices. The video we're going to shoot here at the end of November, we're going to get into the actual bull run we showed last time from 1981 to 2000. And just showing how the market has pulled back and how it consolidates its gains, which is healthy, so that it can go on to make new highs. And so we'll shed some light on that in our next video. Thanks for watching. Smash the like button and subscribe to our channel, because we're going to continue to put out content like this. And please let us know if you have any questions. Thanks, everybody. Goodbye. The material in this video has no regard to the specific investment objectives, financial situations, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or an offer to buy or sell a security or any other related financial instruments. Nor should any of the content be taken as investment advice. Any of the opinions expressed in this video are subject to change without notice, and Uncommon Wealth Partners LLC is not under any obligation to update or keep current the information contained herein. Uncommon Wealth Partners LLC and its respected officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. Uncommon Wealth Partners does not accept any liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.